What's up, guys? How we doing? All right, so it's a Friday afternoon. Let's talk ETFs for a little bit. I confess, okay, I have a confession to make, and that my confession is I don't really have a ton planned for the show today. So here was what my thinking was. We'll go over like the weekly gainers and losers, winners and losers in terms of returns and flows. And then I want to talk a little bit about leveraged ETFs, what they're good for, what they're not good for. And then we'll just do questions from chat. We'll just kind of hang out. We've got Zinger Nation stock trivia on at 3 o'clock. Solar up and up. Trying to stump me already. Is there an ETF for ETFs? Yeah, actually, I think there is. And if there isn't, then there used to be. But I'm pretty sure that there was once upon a time an ETF of ETFs. But again, top of my head, I don't remember. But that's a great question. Solar up and up. Okay, so let me share. Blake C., I see your question. Blake C. has asked, I think a couple times now, on the proposed DTCC rule changes. I guess what you're referring to, Blake, is the shift from T2 to T1, right? That's what the rule change is. I only just kind of read like the press release from the DTCC. I haven't gone too far into it, so I don't have too informed an opinion. But anything we can get that's like closer to T1 is better, right? I think generally speaking, and also what the rule changes, what the proposed changes are is like is trying to prevent what happened to Robinhood last month or the other month, and basically they're saying this is according to the press release, if we ask for money, if your clearing is screwed up or whatever, and your books are off, and we ask for money, we want money now. So I don't have too much of an opinion on that, Blake C. But it seems like they're just trying to prevent what happened to Robinhood back in January, and I guess we'll see if it ever comes to fruition. But anything that gets us closer to T1 or instantaneous settlement, I'm generally for. Okay, let me share my screen, and we can go over what happened this week. First of all, did you guys see that FOMO ETF? It's from Matt Tuttle. I have reached out to Matt. I want to try to get him on our show next week. And he's basically just launched an ETF that is the ultimate, is basically like the ultimate YOLO trade ETF, FOMO. It's nothing's been approved yet. But it's like the ultimate like late stage, like late cycle ETF. Okay, real fast. Let me get Blake's comment off the screen there so we can move on with our lives. Okay, I've got my screen shared. I've got etfdb.com up. Real fast, refresher course. Why do we love ETFs? Number one, they're diversified. Number two, tax efficient. They have low fees, usually, though we'll get to that today a little bit. Actively traded throughout the day, not like mutual funds. Transparent, again, usually. And those are the reasons why we love ETFs. So, going to our ETF screener here, top performers of the week. Look at that, guys. Look, this is not the case a week ago. A week ago, it was all energy, right? It was all oil and gas and energy and like MLPs. Don't see that anywhere on this list. I see like Block, which is like basically a kind of like a blockchain ETF in a way. I see retail, which really at this point is a lot of like e-commerce. Small cap, video game tech. The Moonshot ETF is back. Cannabis is back. Clean energy is back. Growth back in favor this week. Huge reversal from last week. Okay. As far as our biggest losers, let's go down. A lot of really complex VIX products that I'll be frank, I don't understand. And so we're going to talk about these at a later date. But before I do that, I need to do my homework on these ETFs, because the thing about ETFs is they make complex strategies easy to access. But just because they're easy to access does not mean you should do it, right? And that's kind of the theme of today's broadcast as well. Going on to fund flows for the week. Look at that. Now that is interesting. A lot of people are chasing. That's what that tells me. People saw what happened to XLE. Let's go into my Benzinga Pro. Let's look at XLE. I've got leverage retail. Let's look at XLE. This is a weekly. Let's go to a daily. Yeah. People see that and they get excited and they want to chase. That's what that tells me. They're chasing. Those flows, they're chasing performance. Nothing wrong with that necessarily, but a lot of those people are probably down now. Go back to that chart. I don't know. I guess maybe they're not. Kind of a flat week though overall, right? Let's go back. See where the flows are. I see some emerging. I see a lot of value. It's the same story, right? Because value's been in favor and everyone's talking about it. Now people are chasing. That's very interesting to see some value stocks or value ETFs. ARKK. Hey, there's been some talk, some speculation about what would happen to the ARK funds if they were to ever get like an avalanche of outflows. Well, that hasn't happened. That's not happening. Not in the last week. Not to their flagship fund. As far as outflows, again, not a surprise to see like SPY and GLD or HYG like at the top here, because these are also used as trading instruments. So like there's nothing really to see there. Okay, that's interesting. ARKG, ARKW, not insignificant outflows. That's notable for sure. I own that ARKW, and I'll bring on my list in a second there of what I own. What else do we see here? Discretionary. Yeah, there's the okay. So the ARKK has a lot of inflows, and then all the other ARK funds have a lot of outflows. That's interesting. Okay. Let's go to my list of what I own again, just so y'all can see. I'll zoom in there. Alphabetical order, nothing crazy, right? Again, the bottom two represent about 2/3 or a little bit less than 2/3 of my overall portfolio. The rest of these are smaller positions. And again, trying to figure out how to reallocate, right? I talked last week about, or the other day, about wanting some an industrial fund. Got to figure out what to sell first, I think. Haven't quite figured that part out yet. Okay, let's go to the lesson of the day, which is going to be leveraged ETFs. Why they're great and why they're not. So let me pull up a chart of what I believe is the top performing leverage ETF of the last year. RETL, the Direction Daily Retail Bull, 3 times shares. All right. Now, on paper, this looks like an amazing investment, right? Let's zoom out. Let's go back to you. Look at that. You could have bought this thing for in the single digits a year ago, and it's now $234, almost $235. All right. Looks amazing, right? Looks like a great investment. Wrong. These are not investment. These are not buy and hold vehicles. How do I know that? Because Direction's website says so. Okay. Where was I? Let's go right there. Okay. Oh, stuff going on behind me. Okay. Direction shares are not suitable for all investors, should only be utilized by sophisticated investors who understand leverage risk consequences of seeking daily leverage or daily inverse leverage investment results and intend to actively monitor and manage their investment. So let's talk about that daily thing. Okay. Let's go back to our chart. Here's the name of the ETF. One word there is key though. Daily. That's the word that matters. Daily. When we talk about leverage ETFs, we don't mean that the fund will get you leveraged, magnified exposure over however long the time period that you held it, right? That's not what the funds do. They give you leveraged exposure for one day. One day. That's what you get. In other words, in the case of RETL here, I don't know what the index that they track is. I'm sure it's like some S&P or MSCI retail index or whatever. Okay. I'm sure we can look it up, and I'm not going to. All right. What RETL does is it gives you 3 times exposure to the performance of that index, that retail index, for 1 day. And then that exposure resets. And they do this via options and swaps and other types of derivatives. So let me pull up a chart that I am borrowing from Investopedia. I want to give them credit because I took this chart from Investopedia. And it's a really good chart, I think, that shows why these securities, these assets are not buy and hold. Okay, so I want to give Investopedia. I was gonna make my own chart, and then I saw this, and I was like, let me just use this. But I want to give them credit. So here, source Investopedia. All right, there's a lot of numbers here. I want to bring your attention to two numbers though. Okay, top left. This is an example of what an index and a leveraged fund would do over the course of a given week. Okay, so our top left, Monday morning, our index is at $100. Okay, Friday evening, our index is at 100. So in this example, from the opening of the week to the close of the week, the index did not change. It started at 100, it ended at 100. Okay, so no change to the index. What about the leverage ETF that tracks the index? Started at 100, Monday morning, Friday close, down 20 cents. Now that doesn't seem like a lot, right? You're down 20 cents. But compound that over time, and yeah, that matters. And all these calculations here they just show you what happens with the daily rebalancing, right? And it's basically just like simple math stuff, right? If the index goes up 1%, you go up 3%. Index goes down 1, you go down 3. And just because of the math of larger numbers, your losses get magnified. The more you do this daily rebalance, this daily dance, the more it drags on performance, okay? So it might seem like RETL is an amazing investment, but it's not, because that daily dance, that daily rebalance, it creates a drag, okay? It creates a drag on long-term performance. It might not seem like it, but it does. The other thing that I want to, if I can go off that chart and go back to my my screen here for a second, the other thing is, we talk about investing. It's all about a snowball, right? It's all about compounding. It's about momentum. But what are some things that create drag? The daily rebalancing creates drag. What else creates drag? Fees, right? Fees create drag on performance. Here is a table of just leveraged ETFs. And look at these expense ratios. Look at these fees. Let me zoom in. You can't even see. You zoom in, okay? Look at these fees. It's expensive to run these things. It requires a lot of trading, right? These firms, Direction, ProShares, they got to be active in the markets. It takes work. And so because of that, these funds have higher expense ratios. And there's nothing wrong with that. That's okay. But over time, those higher fees will create drag, right? It will get in the way of the compounding effect that you want. So between the daily rebalancing and these higher fees, your returns, if you owned ROTL, it will not look like this, right? It will not look like this chart. Your returns will lag the performance of this chart. I promise you. Okay. Direction themselves, ProShares, Direction, they both say, if you're going to own these things, please actively manage them. Pay attention. Don't ignore your portfolio for a month. Don't buy this thing and then go on vacation for a month. Don't do that. They tell you to listen to them when they say that, okay? And the same thing goes for inverse, right? Let's just go to here. Let's just go to Yang is like an inverse Chinese ETF, right? It's the same thing. It's leverage. It's just inverse leverage, right? So this goes up as the index it tracks goes down and vice versa. But it's the same concept, right? Same concept as leverage, it's just inverse leverage. You got to be active. You got to be managing this stuff, okay? You can't set it and forget it. That's not what they're for. They are for using as part of, like, so for example, if you are like long, like up to your neck, you're up to your eyeballs in like Alibaba, right? In Baidu and JD and all these like Chinese stocks, right? You're up to your eyeballs and you're so crazy long and you want to hedge yourself. Maybe Yang, right? Is an option. There is a million ways to hedge yourself. You can use options, you can use ETFs. These ETFs are great hedging tools. But again, short-term hedging, not long-term hedging. How do you calculate the drag / fees, Jason? Every fund will tell you what the fee is, right? They'll tell you what the expense ratio is. Where's my here? So this is ETFDB, but you can go to any fund website and it'll tell you on the fact sheet what the ratio is. These numbers, these are high, right? This fee is basically like 100 times the fee of like SPY or like VOO, right? Those expense ratios are like 0.03%. And we're talking about like over 1%, right? So like expensive compared to, it might not seem like a lot, but it is, right? It creates that drag. 1% seems like nothing, but I'm telling you, it's not nothing, okay? ETFs have brought, by and large, ETFs have brought costs down, and that's fantastic for investors. But be mindful of ETFs that have higher fees. Okay, leverage ETFs have higher fees. They're just more expensive to manage for the issuer. It takes more labor. It takes more trading. They're constantly trading because they have to constantly rebalance, right? Every day they have to reset their leverage, and every day they got to gain magnified exposure to whatever the index is doing. If it's up 1%, they're going up 3%. If it's down 2%, they're going down 6%, right? It can be great in the short term, not so great in the long term. Here's a question. All right, let's go to the chat here. Can an ETF that hasn't yet gone live, i.e., I guess that's the space ETF, ARKX, purchase stocks ahead of its commencement date, perhaps by using an investor account from which those shares will be transferred? I don't know, but I'm going to find out. That's a very good question. Typically, well, not typically, always, an ETF won't go live without assets under management already, right? Like no ETF will go live with zero assets. They will already go live managing some money. So I would presume that similar to how the funds have to rebalance at the last possible second, right? If you're familiar with like the Russell rebalance or the S&P rebalance, like when Tesla got added to the S&P last year, everyone waits till like the last possible second to rebalance their funds. What I think happens, and I don't know this for sure, but I'll find out for you, is because they're already managing some assets, they already go to market with like 50 million or whatever, some small number. They will at the last second before it goes live, they'll start buying, right? So that when they do go live, they do represent the assets. The one share of the fund does represent all the shares in the basket. But that's good. That's a great question. So I hadn't thought about that before. That's a good question. I think that's what you're asking. But we'll have to. I talk to issuers all the time, so I'm going to ask them that question because that's a really good question. Are ETFs better than individual stocks? Better for what? Better for diversification? Hell yeah. Better for returns? Don't know. Right? It depends. It depends on the ETF, depends on the stock, depends on your time horizon. They are more diversified, right? I like ETFs because I don't want to have to go and drill down. Like if I want to own an industrial stock, like how am I going to pick the right one, right? There's 1,000 of them. You can just own all of them at one time. That's kind of why I like ETFs. So better is a subjective term. Turbojet 1, I don't know the answer. but they are more diversified. So from that point of view, yes, they are better. Let me see if I missed anything from chat. Did I forget to cover everything about leverage? Someone had tweeted me to ask about to do a thing about leverage and inverse funds. I'd spoken to Dave Mazza from Direction on our show last month. He'll tell you the same thing I just did. Great instruments for active trading, not great for long-term investing. Please. At the very longest, like you should hold a leveraged fund at the most. I guess theoretically, if you're watching it all the time, you can hold it forever if you're watching it. But I personally, like, I wouldn't hold a leverage ETF for more than like a few days, right? Like a week. And the other thing is, like, if you're going to hold one of these things, you want to hold it in a trending market. You want with leverage ETFs above all else, the trend is your friend, okay? Because the daily resetting, if you're constantly going back and forth, up, down, up, down, then you just saw that example that I pulled up earlier where the index goes nowhere and then you lose money. But if you're in a trending market, it doesn't matter what direction, up or down, that's what you want. That's when it can really juice your returns, right? In a trending market where there's a clear directional trend and you get that added exposure to that trend. You do not want up and down. You do not want that. That'll just kill any performance. Okay. It is 2:59. What's the website for Robert for options? It's Wealth Builders HQ. Wealthbuildershq.com. That's for Trade the Unknown. Jay Rice is probably right. XRT is up because its largest holding is GameStop. Yeah. I haven't looked at the XRT top 10 for a minute, but you're probably right. I don't even have to look to know that. I think you're right. I'm even if you're not, I'm just going to pretend you're right. Okay. What do I say about SOXX? SOXX, the SOX, one of the semiconductor ETFs. Let's take a look at the chart. I think if you believe semis are the future, which a lot of people think that they are, semis and batteries, then it's a great way to get exposure, right? Let's see if we can look at the top 10. Let's go here. Up next is Zinger Stock Trivia. Guys, are you ready yet or no? They said about a minute, so we'll hang on here. Okay. So all the big names, right? No surprises here. Pretty sure this is the largest semi ETF by assets. Again, there's like a global shortage of semis, right? So if you want exposure to semis, you can do a lot worse than SOXX. You can do a lot worse than that. It's how I would play any thesis, right? And that's just my opinion. If I wanted to make a bet on semis, I would do it via an asset, a security like SOXX. I would not buy AMD or NVIDIA or Intel. What else here? Let's say I'm in an ETF that goes up and down. Yes, Jason B, that's exactly right. Particularly with I'm talking about with a leveraged ETF. With a leveraged ETF, leverage or inverse. If you're going up and down every day, just take a pen and do the math, right? If the index goes up 1, you go up 3. So if you start at 100, index goes to 101, you're at 103. The next day, you go down 1%, and your index is a little bit higher than 100, right? Because 101 minus 1% is a little more than, it's what, like 110 cents. But your ETF goes down below 100, right? Just do the math in your head, and plus the fees. That's what creates the drag. QQQ is a great ETF. It's the second oldest ETF. It's like the second largest in terms of AUM. Actually, I don't know if that's true. Let's see if that's true. QQQ is also very commonly used as a trading instrument. So it is the 1, 2, 3, 4. It is the 5th largest ETF by assets, AUM, right? Very commonly used as a trading instrument. That does not mean you can't invest in it. SPY is used as a trading instrument by people who want to hedge. Dennis Dick uses SPY all the time to hedge. He uses QQQ all the time to hedge. But you can do both. You can use it as a trading instrument. You can buy and hold QQQ. That's fine. This is an appropriate long-term investment if you believe in the NASDAQ 100. Okay? I'm not telling you to buy that. I'm saying if you believe in the NASDAQ 100, this is an appropriate buy and hold instrument. Is IDRV, first of all, I'm not going to tell you if anything is a good buy. Okay? I'm not an advisor. IDRV. I don't know this one. I've never even heard of this one. IDRV? Okay, it's relatively new. What the hell does it own, though? All right, iShares, reliable brand. So far, so good. Expense ratio, not crazy low, but not crazy high. That's fine. What the hell does it own? Okay, so it's going to go with Tesla, more or less. Yeah, hey. I didn't know this thing existed before 5 seconds ago, but I'm intrigued. Let's just see some more charts. Okay, mostly tech, mostly North America, but some Europe. That's nice, actually. That's a nice diversification between Europe, Asia, and North America. That's pretty good. Kind of get a little bit of everything. I don't hate this. 100 holdings, 30% of the top 10. That's not crazy concentrated. Yeah, this isn't bad. What's the AUM? Pretty small. That's not bad though. That's not bad. 300 million AUM. It's not microscopic, but it's not large, right? Generally speaking, 100 million is your breaking point. If a fund can't attract 100 million after a few years, then they may just pull the plug. So it's well over that threshold. So, you're not in danger of the fund closing at all. It's iShares. I mean, they're the second largest asset manager, right? ETF asset manager. So, they know what they're doing. That's interesting. I'm intrigued. I haven't seen that one before, but I'm going to check it out this weekend. That's a very interesting fund. Okay, it's 3:06. I have to get off because we've got trivia coming up right now. Benzinga National Trivia. Guys, are you ready? They say they're ready. Okay, they better be ready because I'm about to end the stream. All right, hit that like button, please. Thank you very much. Likes are how I eat my dinner. So without likes, I don't eat. Thank you very much. And I'll see you guys in a half hour for pre-market prep at the close.